the credit tickler system updates of financial information, updates of appraisals, recording mortgage. So these are some of the things that they've identified as part of their controls and processes that they think are important. You may come up with your own, depending on your size and your organization. You may have different ones. But this is something that they identified in this example. So what are we going to do with this? We're going to take those controls and processes. We're going to tag the risk categories that are relevant to them, and then assign a risk grade of high, medium, low. How important are these controls relative to that risk? How do we do that? Well, one of the ways you can sit down, like you said, either talk it out. You can have a risk control questionnaires. Majority of the banks already have some sort of a methodology. You have your BSA or regulatory compliance risk assessment, etc. So you probably have a lot of guidance already or assessment within your organization that will help you decide the risk grading for each of those controls. But the most important thing to start things out, we want to keep things simple. We don't want to get it complicated. It may sound a little complicated, but I think maybe the best thing is to take a look at an example here. All right, so in this example here, these are the controls that we talked about for the lending area had identified. Legal loan approval, periodic calculation, review of ALL. So we put this on this spreadsheet. Now, you don't need necessarily, this is designed, you don't need a software. You can do this on Excel, or you can get a software, but the idea is you want to be able to take a practical aspect of doing it. So in this example, they sit down, new loan approval, and these are our risk categories up on top. You should be able to point. There we go. Financial reporting, operational, credit, information system, reputation, strategic. So now what we want to do is set our inherent risk setting for each control. So based on their assessment, they believe the new loan approval for financial reporting purposes, moderate risk. Operational, low. Credit, moderate. Strategic governance, moderate. Information systems, they said there's really no impact. So some of these risks may not apply to a control. It doesn't mean everything has to. So they go through each control and set a risk grade for each risk category, and they come up with an average for that control being overall moderate. At the same time, if you go through every single control and you set your risk settings, you come up with an overall inherent risk for financial reporting for the lending area as being low. Operational risk for the lending area, low. Credit, low. Information system, moderate. Overall, their inherent risk, their system suggests is low for the credit, for the lending area. If you make a mistake here or there, it's not the end of the world. So the most important thing is not to get writer's cramp and not do it. The idea is to start the process. Because once you start it, and then you'll tweak it as you go along. And you certainly will make mistakes, and you'll see, and you'll adjust them. But it's not the end of the world if you make a little mistake in terms of setting these inherent settings. So once we set the inherent risk, now what we have to do is, now we've got our benchmark. Now we have our benchmark, our starting point. And now what we have to do is come up with a way we can figure out how we measure residual risk. Are we doing things right? Residual risk is the concept of adjustment. If you don't do something, you start out with your benchmark. If you do it right, you can lower your risk. If you do it wrong, you raise your risk. So the end product is dependent on how if you have the controls or processes, if they happen the way you designed them to happen. So residual risk is the assessment of risk based on how well the institution is managing, implementing controls and process and business strategy. So this is what I says, measuring the change in risk, if any, based on how well we manage our controls or processes during the period. And again, we look at each functional area, review the list of controls, assign all right, this explains how we can sort of measure residual risk, and probably make more sense when I get to the example, but I'll read this out anyway. For each of the controls that we had identified, one of the ways you can, for example, we talked about new loan approval. That's a control. Now, if we're going to be measuring risk over a period of time, we want to measure is target dates. Within that period, were they all the loans approved by the loan committee? If you have an ALL loan approval as a key control, if it has to be prepared within a certain time period, if that's important to you, you set a target date within which it has to be done. And you assign responsibility to their personnel. And if it is completed, if all of those things are completed, then you get credit for it. You're able to lower your risk. If it's not completed, if it's not done, then you elevate your risk. That's basically the concept this says. So let's go back to that example, and I think it'll be more clear here for you. Again, the lending area, we have all the controls, the same controls we talked about before, new loan approval, periodic calculation. And now we're measuring this risk for the quarter ended March 31st. So this quarter, we take a look, and this is a result of the controls. We notice a new loan approval, all approved prior to funding. So every single loan in the quarter was approved by the loan committee. And then what we do is we set up a deviation rate here. If the deviation rate for that control is less than 5%, we put an X in here. That means we're actually able to change our risk. We can lower our risk because the deviation rate was less than 5%. On the other hand, periodic calculation and review of ALL, which was required to be done within 30 days of the quarter end, wasn't completed. Therefore, this is only one aspect of it. The deviation rate is a maximum here, and here there's an adjustment too, and now we increase it by. So each one of these deviations can either lower, remain the same, the risk, increase it, or increase it 2 levels. And changing the risk level, this column right here, is really what we're trying to gather to measure residual risk. So we want to be able to take our inherent risk and be able to move it in direction based on whether the controls and processes actually occurred or didn't occur. So for example here, Mike Jones, now we know Mike Jones, or M. Jones here, was a responsible person. He helped reduce our risk. M. Hunter didn't prepare the allowance for loan loss, it elevated our risk. So we go through each one of these things, we look at updates of financial information. During the quarter, we updated the follow-up. We noted that update follow-up was not performed on 22% of loans. The hardest part, when we talked about this earlier, the hurdles in the CRM is getting this information. This is pretty easy. Getting this information, setting a system up so you can get this on a routine basis is really the hardest challenge. That's why you need a buy-in from your department if you're going to do it manually. Or if you have a software that does it, then that's a little bit easier. But if you can do it manually, you have to sit down with the department, be able to get this information and have some reliability on this information so that you know how you're adjusting your risk. Because how you're adjusting your risk is really dependent upon this. Site inspections not performed for 32% of required loans. Well, that's a more than 25% deviation. And that's going to increase it twofold. It's going to elevate our risk. Training, required training not performed this quarter, was supposed to be done. That elevates our risk. So this is a methodology for the same controls that we identified, and then we look at whether it's a monthly result or quarterly, whatever, or 6 months or annually, whatever you're doing it, now you measure the results.
Could you go back to that a second?
Sure.
And I know this is just an example, but the ones you've explained were yes, and that makes sense. But you've got no on some of those that were still deviations.
Yeah, but this is what we call tolerance of risk. So what we've said is between 5 to 10%, we understand there's going to be some, and for this particular control, at 5 to 10%, whatever inherent risk is, we're okay with it. We know that. And we're not going to change, elevate the risk because of that. That's our risk appetite. We're okay with that. Right. And this is not etched in stone. These deviation rates up to you. You may say, no, we don't want a 5 to 10%. We want to change it up because that's our culture. But this gives you the ability to do it whichever way you want.
So then as an organization, we decide what's acceptable and then needs to go back and do retests. So for instance, new loan approval, we may look at once a year, but for periodic calculation of ALL, we may look at quarterly because it's outside of all this policy, correct? Is that what this is telling us?
Well, new loan approval, we're looking at, obviously, if you're approving loans, and you're looking for this quarter, all the new loans that were approved, were they approved by the loan committee in this quarter?